Ever wonder why the stock price on your phone screen keeps ticking up and down like it's got a mind of its own? You might picture some guy in a suit at an exchange manually typing in a new number every few seconds. That's not it at all. In this beginner-friendly breakdown, I'm going to show you exactly what's happening under the hood. First, the mechanics. What's physically causing that number to jump around all day? A constant tug-of-war between people trying to buy and people trying to sell. Then, the bigger question, what actually determines whether a company is worth $2 a share or 2,000? Why do some stocks rocket overnight while others collapse? Welcome back to the channel. Quick heads up before we start. None of this is personalized financial advice, just education. So let's start with the basics. A stock exchange is really just an enormous, noisy bazaar. Buyers on one side, sellers on the other, arguing over price nonstop. Here's the part most new investors never learn about, and it's genuinely fascinating. The order book. Picture it as the market's live scoreboard, constantly refreshing with two columns. On one side, the bids, what people are offering to pay. On the other, the asks, the minimum sellers will accept. Somewhere in the middle, a trade actually clicks, and that's the number that gets published as the price. Here's the twist beginners usually miss. That price ticking on your app isn't a guarantee of what you'd pay right now. It's just a record of the last trade that happened. The next trade could be higher or lower depending on what's sitting in that order book at this exact moment. So how does the tug-of-war actually play out? When buyers get eager, say a company just announced a blowout earnings report, they stop being patient. They raise their bids higher and higher just to get someone to sell to them. Think of it like an auction where everyone keeps outbidding each other. That pressure pushes the price up. Flip it around. When sellers panic, bad headlines, a scary earnings miss, they start slashing their asking price just to offload their shares before it drops further. It's like a clearance sale where the price keeps getting marked down until somebody bites. That's what drives a crash. Okay, that covers the how. Now let's get into the why. What actually determines what a company is worth? This is where we need to bring in the idea of fair value. Fair value is essentially an estimate of what a company is actually worth once you strip away all the hype, fear, and headlines, based purely on its business fundamentals, profits, assets, and how fast it's growing. It's not a fixed number that everyone agrees on. It's more of an educated guess, and different analysts can land on wildly different answers for the exact same company. Why bother calculating it at all? Because it helps you figure out whether a stock is a bargain or a ripoff. If the market price sits below your fair value estimate, the stock might be cheap. If it's way above, it might be overpriced. But remember, this is an estimate, not a fact. It's closer to guessing next season's harvest price than weighing a sack of grain. There are a handful of common ways analysts estimate this. No single one is perfect, which is why most professionals blend a few together. Method 1. Discounted cash flow. The idea is simple. Estimate how much actual cash a company will generate in future years, then adjust that money back to today's value, since $1 next year is worth less than $1 today. Say a business is expected to generate $200 a year for the next 3 years, using an 8% discount rate. Those future dollars are worth roughly $185, $171, and $159 today. At a terminal value, an estimate of everything the company earns beyond that window, say $1,500, discounted down to about $1,190. Total it up, divide by shares outstanding, and you've got a rough per share fair value. If the market price sits below that number, it might be a bargain. Method 2. The dividend model. This one only works for companies that regularly pay shareholders cash. If a company pays $3 a share today and you expect that payout to grow 4% annually, you can work backward to estimate what the stock should be worth based on that income alone. Great for slow, steady dividend payers like utility or telecom companies. Method 3. Net asset value. Add up everything the company owns, property, equipment, cash reserves, then subtract everything it owes. What's left, divided by shares, is a rough floor value. This works best for asset-heavy businesses like banks, insurers, or real estate firms. Method 4. Earnings multiples. This is the quick and dirty version. Take the company's profit per share, multiply it by whatever multiple similar companies in its industry trade at. If comparable software companies trade at 25 times earnings and your company earns $4 a share, that puts fair value around $100. Some investors build their entire strategy around this concept. Value investors, most famously someone like Benjamin Graham's most famous student. They wait for a stock to trade below its estimated fair value, buy, and hold for years, ignoring the daily noise. But plenty of stocks trade way above what the numbers alone would justify, especially in hot sectors. Look at a company like Nvidia a few years back. On pure current profits, the price looked stretched. But investors weren't paying for today's earnings. They were betting on tomorrow's. Why does this gap between price and fundamentals happen? 3 big reasons. First, sentiment. When a sector is exciting, investors bid prices up regardless of the actual numbers. Second, expectations. Fast-growing industries like AI or biotech often trade rich because people are betting on massive future profits, not current ones. Third, macro conditions. When interest rates are low, stocks look more attractive than bonds, pulling money and prices upward across the board. For brand new companies with no profits yet, this calculation basically breaks down. Their fair value on paper might be near zero, yet the stock trades high purely on the promise of what they might become. So is any of this actually useful? For patient, value-focused investors, absolutely. It's a great filter for stable, established companies where profits and assets are easy to measure. Think a company like Procter & Gamble. But for high-growth investors chasing the next big thing, it often takes a backseat to a totally different question. How big could this get? And one last caveat. These are estimates built on assumptions about the future, and the market can stay disconnected from fair value for years before it corrects, if it ever does. That's the beginner's tour of how stock prices actually get set, the mechanical tug-of-war of the order book, and the deeper question of fundamental worth underneath it. As always, this isn't financial advice. Do your own homework or talk to a licensed advisor before making any moves. If this helped clear things up, a like and a subscribe goes a long way. Thanks for watching, and I'll catch you in the next one.